Hi, Jim Krzan here, and welcome to the first quarter's capital market review covering the period from January through the end of March. Let's get into the slides. You know, as we enter the second quarter, we're beginning to see let's say a little bit of a pause with this global pandemic that we've had. But we're certainly facing new challenges as well. The brutal Russian attack of Ukraine, stubbornly high inflation, and a more hawkish stance by the Federal Reserve. As such, equity markets have been quite volatile. Bond markets have been even worse since the first of the year. So I thought it would be a good opportunity to maybe take a step back, reassess where we are, and look at current situation, as well as perhaps some opportunities. At the end of the day, the economy matters. So we're going to dissect several major components of the economy. We'll look at economic growth, the jobs market, corporate profits, inflation, and obviously interest rates. We do this in an attempt to understand where we are today, as well as where we're heading. To adjust portfolios and allocate appropriately, we need to get two things right. We need to understand where we are within the economic cycle. As a result, there are areas where we would want to invest and areas that we would certainly want to stay away from. And we also want to understand where the Fed is. Are they friendly and accommodative, or are they beginning to restrict and as a result create potentially down the road some headwinds for the economy? Today's agenda is really quite short. We'll spend a few moments talking about the Ukraine and pandemic update. We'll talk about the pace of recovery, monetary policy, and some of the risks and opportunities within the capital markets. Let's first start with a brief discussion about Ukraine and pandemic updates. You know, because of government policy, because of the Russian invasion of Ukraine, we've seen a huge spike in energy prices and also a spike in food prices as well. Fortunately, as you'll see with slide 1, the effect of those increases as it relates to household spending, effectively wallet share, is much less today than it was 50 years ago. At one point, food and energy represented about 27% of our budget. Today, more like 12%. Energy alone was about 7.5% of our wallet share in the early 60s. Today, it's about 4.3%, much, much less. Another positive is that because of fracking and improvement in technology, our net imports of oil as a percentage or share of GDP is also quite low. In fact, it's net zero. That is significantly different than it was during the OPEC oil embargo of the 70s, or as it was during the financial crisis as well. So both of those things will effectively have a smaller impact on our economy. Spike in energy is problematic, but it's not nearly as problematic as it once was. On a brighter note, COVID cases appear to be dropping significantly. We are seeing both confirmed cases as well as fatalities dropping literally down to the lowest levels we've seen since the pandemic started. Now, obviously, there is a new variant, and it is quite contagious, but it appears that it's not driving a spike in hospitalization. As a result, we're beginning to see improvement in travel, leisure, and just generally moving about. If you look at the slide on the right, it talks about certain components of our economy, things like hotel occupancy or seated diners in restaurants or TSA travel. And in all cases, we're beginning to see huge recovery. If you look at just simply seated diners, at the very worst point within COVID, we had a 100% drop in seated diners. Nobody was seated inside restaurants enjoying meals. Today, the number of seated diners has increased appreciably, and we're only 3% from the peak prior to COVID. TSA travel has also improved quite a bit, dropped nearly 96%, and today it's trailing behind its peak by only 11%. So we should expect to see continued improvement in those areas as the economy continues to lift from these COVID and mask mandates. Let's talk a little bit about the pace of the recovery that we see. This chart talks about economic growth, and our trend line in our economy here has been about 2% a year. That's typically what we expect the economy to grow year over year, and that has been the case over the course of the last 20 years. By historic standards, that's a little anemic, but that's effectively what the trend rate has been. If you look at the gray line to the far right, you'll notice that we had a huge drop in GDP activity and a recovery since. Effectively, in 2021, we recouped 100% of what was lost in terms of economic activity. In fact, we actually surpassed the prior peak by about 3.2%, which is substantial. As we move throughout this year, what we're going to see is probably some constraints in terms of productivity. A lot of the growth has been productivity driven. In fact, productivity or output per worker has increased by about 2.7%. That's twice the 1.2% rate of our historic trend. So we expect to see some issues there, capacity issues, the fact that there are many, many fewer workers than jobs. And the thought is we will see year over year GDP and something more like 3% as we move closer to the end of the year. If we look at unemployment and wages, we're seeing an improvement in wage growth rates. In fact, the labor market continues to improve quite a bit, and the unemployment rate continues to drop. Today, it's about 3.8%. And that's a significant improvement from where we were just a year ago at about 6.2%. We expect rising wages plus fading pandemic assistance will help drive the unemployment rate even further down. A number to consider is 3.4%. If we get to that rate, that will be the lowest unemployment rate that we've enjoyed going all the way back to 1953. That said, this will cause and continue to cause some impact on inflation. Within this, we're also seeing a couple of other trends emerge. One is baby boomers are certainly beginning to retire out. We're also seeing limited immigration policy, and both of those have a suppression on labor force growth. Demand for labor will continue to rise, and yet we haven't the labor growth rates that we need. So as a result, that will create some systemic structural inflation. More than likely, our inflation rate will reduce, and it'll probably be closer to high 2s or low 3s for some time to come. Last year, corporate earnings were spectacular. In fact, earnings hit an all-time high last year. This year, however, we may see a little bit of a change. This year, we should see slower earnings growth because of higher wage rates and also higher interest rates, both of which will impact profits and will probably push profits into single digit status as opposed to double digits as we've enjoyed the prior year. Inflation is certainly spiking. We're seeing that. This chart, which talks about CPI and core CPI, has shown a large spike above long-term trend line. Now, that long-term trend line includes the 70s. If we excluded the 70s, the trend line in the last decade or so was probably a 2 handle, probably closer to 2 than slightly above 3. But the inflation rate certainly has spiked. And it was a combination of surging consumer spending, fueled somewhat by stimulus, and that trend collided with supply shortages as well. The expectation is as we move throughout this year, we will see an improvement in supply chain. And we expect inflation to be a bit closer to 3-ish% when we look at year-over-year numbers toward the end of this year. Again, kind of falling into somewhat the Fed's policy or thought that a lot of this inflation may very well be transitory. Let's talk about government spending and in particular monetary policy. The Fed is certainly hawkish. They're planning on raising interest rates. And if we look at this chart, and in particular the far right of the chart, we're seeing what's called the dot plot. It is effectively where Fed presidents think interest rates will be over the course of the next several quarters. You will see it is vertical. It is moving left to right in a very strong pace. That is significantly different from what this chart looked like just simply 1 year ago. The dot plot looked very horizontal, very flat, somewhat less than it is today. In addition to a high expectation of much higher interest rates, and again, the Fed only plays with the discount rate, which is the shortest yield rate on a yield curve. We also have another impact that might cause interest rates throughout the yield curve, intermediate and longer term rates, to rise as well. Starting later this year, presumably in the month of May, the Federal Reserve will engage in quantitative tightening, which effectively is quantitative easing in reverse. So now they'll be selling some of the bonds off of their balance sheet, off their inventory. And as a result, it will effectively cause rates to rise throughout the yield curve, much like quantitative easing brought the ceiling of rates throughout the yield curve down appreciably. So we'll see what that does to things like home construction and capital expenditures. Again, could be problematic, certainly doesn't look that way at this point. Because of rising interest rates and the expectation of rising interest rates, fixed income has really had a difficult time. The aggregate bond index through the end of March, down almost 6%. Today, down a little over 8%. And you'll notice that year to date, all bonds, every way, shape, or form, are down a certain percentage. And the percentage that bonds are down, to a large degree, follows duration. The longer till maturity, the more impact bonds have to a rising interest rate. We see that in real time in terms of pricing and yield on the left-hand side of the chart. And we see that statistically as a percentage rise in interest rates, what impact it actually has. This isn't going to change anytime soon. We would expect bonds to continue to be under some pressure. The thought is that interest rates will continue to rise into this year and into next. And the hope is that sometime soon, next several quarters, we should see inflation peak. At some point, we will see peak interest rates, but there's absolutely no clarity into when that could be. This will also have an impact on borrowing mortgage rates etc. Again, the potential for another headwind. Let's turn our attention for a second on the equities markets. This chart tracks price earnings ratio, PE. Company's earnings times PE, or times the earnings multiple, generally dictates or illustrates current price. Back at the beginning of the year, we saw interest rates, or I should say PE ratios, peak. They were about 22.5 times earnings. Today, they're about 19.5. Certainly, they've come down a bit. So not only has the market come down, but PEs have come down as well. And the reason PEs are coming down is because in a higher inflationary environment, as well as a higher interest rate environment, it's very difficult to maintain high PEs. Additionally, we're going to expect wage rate increases and interest rates and higher inflation to also affect profits of companies. So in addition to a reduction in PE, we might very well see a reduction in corporate earnings. As a result, it's causing us to take a much more limited, much more narrow focus on the market. The opportunity set has become much smaller in this environment. Whereas a year ago, with rising PEs and such, it was much easier to throw a dart at a wall and buy just about anything. Today, it's much different and frankly, a bit more difficult. Another trend that's developing is this leadership change from growth to value. Growth has outperformed the market for many years. Growth has effectively outperformed the market for what may very well be a good 10 years or more. Starting really this year in particular, we're beginning to see value outperform. Value, as a general rule, tends to hold its value better in a rising interest rate, rising inflation environment. Additionally, when you look at value versus growth in terms of multiples, price earnings, and you compare it to long-term average, it just generally looks a bit cheaper. Also, value stocks tend to pay income distributions as dividends, which also helps in terms of valuation as it's less discounted for rising inflation, rising interest rates. So we would expect to see that trend continue for some time to come. Value outperforming growth. I feel like a broken record, but I'll mention it once again. The international markets look extremely cheap. In fact, when you look at relative value of the international markets to the US, they're as cheap today as they've ever been the last 20 years. That said, the international markets have and continue to underperform the US for a variety of reasons. One is the relative strength of the US dollar. Earlier this year, the international markets were actually outperforming. Russia invades Ukraine, and there was a lot of European money that moved to safe havens, particularly US dollars, US treasuries, and as a result, the dollar spiked. And that becomes a difficult period of time for international. We think at some point, government policy, inflation, its impact on our economy will certainly cause the dollar to drop. And when it does, it may very well drop for a protracted period of time, in which case the international markets will once again look quite favorable. Currently, as a general rule, we have a very low weighting toward international at this time, but it's something we're watching very closely and would not be surprised if at some point in the future, we have a much higher weighting in international securities. From a mean reversion perspective, it's somewhat long overdue. Last economic slide I want to share with you is that of consumer confidence and its impact on the stock market. If we look at the slide and especially look at the gray line that scribbles across the page to the far right, you'll see that the current sentiment is quite low compared to its peak in 2020, actually February, just before COVID shutdown. And we've seen a appreciable drop, some recovery as a result of the lift off of the COVID bottom, CARES Act and such, and then a significant drop from that point forward. That's a number of things. Election, government policy, it has to do with various variants of COVID as well. But the number today is quite weak compared to where it was at its peak. What's really interesting are those gray vertical lines that you'll see intermittently throughout the chart. That represents these lows that we see, or relative lows or relative peaks in terms of consumer sentiment. The 12 months following a peak or a trough is somewhat pivotal. Again, we don't know when the trough will be put in. We know it's lower today. We don't know if it goes lower further still. But essentially, coming off of a low in consumer sentiment, the next 12 months, the market has a tendency to rise 24.5%. And when the consumer sentiment is high, things could not be better. Generally, the next 12 months, the market tends to improve just 4.5%. So again, this coincides with coming out of recessions, coming out of lulls. The recovery tends to be quite powerful. We would certainly expect that to happen as well at some point, just not quite sure when. So for us, at this juncture, understanding the economy, understanding economic health really makes the most sense. We need to understand where we are today in the cycle, and we need to understand where the Fed is as well. So one of the tools that we use is this tool offered through ClearBridge. They use this to help determine where they feel we are in terms of the economy. They've used this successfully to predict the last 8 recessions. And this is a tool that we look at every single month. What you see in front of you is a summary of the last 3 quarters, March being the most recent. In between the quarter ends, the chart I look at is every single month. So February, January, December, and so forth. What we're looking at are general trends. When the predominant color is green within these 12 unique key components, the overall signal is green, and that would imply very low probability of a recession inside of the next 12 months. Currently, 10 of 12 are green, which will certainly coincide with economist predictions of no recession this year, perhaps 2023. When the prominent color is yellow, there's a high probability of a recession inside of 8 months. And when it's red, high probability inside of 3 months. As you can see, there's been no movement since the end of last year. But if we look at where we are today, compared to where we were in September, we have had some movement. A green became yellow, and then at some point that yellow became red, and another green became yellow. So when we look at large IRAs today, compared to where they were in the fall of last year, we're certainly a bit more defensive. And as this chart continues to get weaker, we become effectively more conservative along the way. And the reason for that is when you look at an economic cycle, which is in blue, and you look at a market cycle, which is in red, generally the cycles look quite similar, although they are not overlapping. The market cycle is predictive and generally runs a bit above or a bit ahead of the economy. So we want to use the chart we've looked at previously as an opportunity to understand where we're heading so that we can reduce exposure in general market risk. If we wait until we realize we're in a recession, it's a bit too late. The market has already corrected accordingly. So with that in mind, I'd like to remind everyone that we're certainly open for business and are here to welcome new clients. So if you know anybody, friend, family member, colleague who has expressed some concern about where we are in the market and what all this means, and would just like to get a second opinion, we would certainly love to help. We do have an elegant process that we use to provide the advice we do, to keep track of where we are with clients every step along the way, and would love the opportunity to provide the same for people you care about. Well, there you have it. That's kind of where things are at the end of the first quarter. Again, we appreciate your confidence and trust. If there's anything we can do for you, please reach out. You can simply call us on our telephone number, 810-593-1624, or reach out via email on our website, www.kaydanwealth.com. I look forward to seeing you again next quarter. And if there's any questions or anything we can do for you, please reach out. See you again real soon. Take care.